Thank you for that warm introduction, and thank you for everyone coming here today. Thank you as well for extremely much for your warm introduction. I have a few slides I'm going to share with you today. Let me see if I can pull them up. I think we got a great introduction already on that. This has been an extraordinarily wild ride for the U.S., right? A lot of strange things have happened to the oil market recently. And really the point of this presentation is to try to understand why the oil price dropped so quickly, where we're going to go in the future. Okay, so what is happening in terms of this structural shift, and will it last well into the future? I think some of you may not be aware who FG is, who our group is. So let me just take a minute to explain what our background is. We actually just celebrated our 30th anniversary. We've been following the oil and gas market specifically, as I said, for 30 years. We initially got our start out of Hawaii, but now our main headquarters are in Singapore and in London. I sit in Singapore. We're a bit unique relative to some other groups in the sense that we focus on the global oil market, but we essentially start in Asia, and we focus from Asia outwards in terms of trying to understand how changes in the oil market will impact. And we've actually, Korea, we've had a long history working with companies in Korea, SKS Oil, Hyundai Oil Bank, GS Caltex, sorry, I gotta get them all in there. And then also on the gas side, Kogas has been a client of ours for a long time, as well as GS Caltex and SK. And then also actually POSCO is a client of ours because they're focused on the feedstocks as well. So we've been, I was asked earlier if I've been to Korea before. I think I've probably been here at least 20 times. So it's, I have a long history coming here. So before we jump in, let me pose a question for you. Okay, so you can't just sit here, you have to think a little bit. Okay, so the part of the point of this presentation is to explain where, or discuss where the oil market will go in the future. Can you think to yourself, where do you think oil prices will go? Okay, so think to yourself actively beforehand. So think next month, I said next month, next year, and then 2020. Okay, so you're probably thinking about the various factors. Where will the oil price be next month versus next year, and then in the long term? I would submit that you're probably thinking about some of the factors that I'm listing here. And they are the key factors to look at the oil market, right? So in terms of short term, we often think about supply and demand, and also potential disruptions to supply and demand. So if you look out there, like in the headlines, we'll see how many rigs are drilling in the US, for example. We'll see a rig count has come into the news a lot lately. And then you'll see actual production in the US. We see weekly inventories out of the US. We get inventories in other areas. So we focus a lot on supply and demand. And then lately, we've been focusing on disruptions to supply, or potential disruptions to supply. And of course, Yemen's been in the news a lot lately over the last couple days, but we've also had nervousness over Iraq at various times. Okay, so those are key short-term factors, and we'll discuss those. Then we look at OPEC, and especially Saudi strategy, okay? Really this large oil price drop was a result of a change to Saudi strategy, and we'll discuss why they changed their strategy. And then finally, long term, where does the market hang its hat? And this might seem a little strange to you, where does it hang its hat? But if you think about it, the long-term perception of the oil market has changed a lot over the last decade. Right? In 2008, there was a perception that we were going to run out of oil. All the talk was about peak oil. And the perception was that oil prices would stay at $110, $120, $130 in it forever. Okay? Lately, over the last few years, if you look over the period about 2010 to 2013, the market seemed to grow comfortable that we were hanging our hat at about $100 a barrel. When I say hang our hat, it's sort of hanging it on the hat rack. So we went from 120 to 110, and now if you look at the market, it seems like we're coming to numbers, or we're getting more comfortable with numbers that are around $60 or $70 a barrel, and I'll come back to why that is in a second. So this was covered already. I think we need to remember, why we're sitting here talking about the oil market right now. A lot of it comes down to the U.S., and I think Nick's going to talk about this later as well. It's interesting when you look around. It's not just oil, right? When you look at the impact of the U.S., it's in all these different areas. An OPEC-size addition to oil production. We saw 4.5 million barrels a day of new tight oil. That's more than a Kuwait, that's more than an Abu Dhabi. Basically, we've created a major OPEC-size producer in the last 4 or 5 years. But also now it's the largest producer of condensates. Some of those condensates have gone to Korean users. It's the largest exporter of refined products, the top LPG exporter in the world. It came from nowhere to pass up the Qataris. Emerging petrochemical exporter. It's going to be amongst the top 3 LNG exporters in the world, an emerging ethane exporter, and it's becoming a coal exporter as well. So every single aspect of the energy market it's impacting. And the key here is we didn't expect this 7 or 8 years ago, right? This is a surprise. So let's take us back. Sometimes our clients ask us, they say, well, yeah, but what were you forecasting 3 or 4 years ago? This is one time. I don't always like to do this, but occasionally we pull out the old forecasts. And what we were looking at back in 2013 is I think what the Saudis were looking at as well. If you look over 2009 to 2013, essentially the Saudis quite masterfully regulated the oil market. And what we have here is we have the call on Saudi production. Okay, so if you take all the demand for oil in the world, all the supply except for the Saudis, there's a gap, right? And to keep the market balanced, the Saudis would have to supply a certain amount of oil. So this line shows you the call on Saudi production. And over the last several years, that call on production has fluctuated between 8.5 and about 10 million barrels a day. So when the world needed more oil, the Saudis increased their supply. When the world needed less oil, they cut it back. And really, they quite effectively kept the oil price moving around that $100 to $115 level. And then something changed, right? They decided, well, we're not going to do this anymore. And I think we can see here why they decided they're not going to do this anymore. Okay? Make no doubt about it. The Saudis could have kept cutting their production and kept the oil price over $100 a barrel. But they would have had to keep cutting and cutting and cutting to balance the market. And we saw even back in 2013 that they'd have to cut their production down to 7 million barrels a day. And they just weren't willing to do this. I mean, why should the Saudis cut back their production so the US can keep increasing production? Russia can keep their production at high levels. Iraq can keep increasing production. The Saudis just said, stop. We aren't going to do this anymore. Okay, so it's very key to keep in mind when we start to think about all the different motivations of why the Saudis wanted to do this, is simply, if they kept doing what they were doing, they'd have to keep cutting their production back further and further and further to make room for the US and other producers, okay? So this also then begs the question, if you look at it, we have to ask ourselves a key question, is was an oil price of over $100 a barrel sustainable? Was it sustainable? Could we keep going along at $100 plus? Well, I mean, we know from working on the consulting side that as the oil price stayed at very high levels for a long time, more and more proposed projects were coming at us that had higher and higher break-even costs. Okay, we started to see some extremely challenging sort of unconventional oil type projects coming at us, okay? Basically what was happening is with oil over $100 a barrel, more and more and more and supply was starting to come in and demand was starting to get killed off. So we would submit, and I think the Saudis also believe, that oil of over $100 a barrel was simply not sustainable. Supply, long-run supply and demand were not balancing at that price. So where does this leave us now? Okay, so we need to think what's going to happen in the short term to oil price. We saw oil price came off quite dramatically through the last part of 2014. We hit lows in January, and then we popped back up. And now we're sitting at that $55, $56 a barrel level for Brent. What's going to happen going forward? Well, frankly, we think we're going to have another drop in the oil price. Okay, so this is something we think is going to happen in the next 2 or 3 months. So it's always dangerous to predict that closely, because then you can tell me if I'm wrong in 2 or 3 months. But when we look out there, and the driver behind this is we just see way too much oil coming into the market still. About 1.5 million barrels a day, too much oil coming into the market. And the way we judge this is, if you look here, is we look at OECD company stocks. And I am going to take you into a little bit of detail here. So when we think about what drives the market, we look at inventories, short term. We're looking at inventories, we're projecting inventories. And you can see here, typically OECD company stocks are around 58 days. Okay, fluctuate around that 56 to 58 days. In 2009, we went to very high levels. And remember, that's when the oil price dropped dramatically, right? And we saw oil go on floating storage, on tankers. There was way, way too much oil during the recession. And if you look at 2015, what's happened, inventories have grown dramatically. And actually, we expect them to grow even more, okay? So we would not be surprised at all over the next few months to see oil drop well below 50, potentially, a little scary to say, but even a little bit, even below $40 a barrel. We just see the market way, way too long right now. There's also often questions about the U.S., okay, and what oil price does it take to stop the growth in U.S. production? The problem with this question is it's really a ladder, okay? It's a ladder. There's not just one price you can pick. There's a ladder between $30 and $80, where some fields are viable at $30, others are marginally viable at $80. And what we've done here is our analysts have tried to break it out in terms of what oil production path we could have expected over 2015 and into 2016 at various oil price levels for the US. Okay, so at the top level here, if oil prices had stayed up, you know, $80, $90, $100, we would have seen US production continue to increase. And you can see our oil price forecast, which I'll show you a little bit later, actually fluctuates around between $50 and $60 for the rest of the year. But you can see that we actually expect, as we move through 2015, that US oil production will actually peak and start to decline. Okay? And we actually think the turning point is around the middle of the year. So we aren't that far away. Okay, we'll still see growth. We will still see headline growth in 2015, but we're going to stop growing, and we're going to start moving on a downward trajectory. Okay? In 2016, probably growth somewhere between 0 and 200,000 barrels a day. So it definitely will have an impact on US production, this recent price decline. Questions about the long term for the US. Now the US, it couldn't keep growing forever, okay? There were certain key fields that were highly productive, but we were going to reach limits eventually for growth. And this has to do with the production profiles in the US. There's very, very steep declines. But we were going to eventually hit ceilings. The question is, where's the ceiling? And you can see here, we put in 2 different price paths. Okay, so there's 3 lines to focus on here. First of all, our production outlook for the US is built up by the colors. Okay, and this shows for all the key fields what we expect for US tight oil production. Basically, we're going to see a decline, we think, in 2016, and then we'll get renewed increases at a much lower growth rate and peak at about 5 million barrels a day. If oil stays at 70, we'd have a lower price path. If oil went to around 90, we'd have a higher production path. So this gives you various different examples of different price paths. I think a key takeaway here is the US is obviously very, very price sensitive in terms of oil production, right? it's a relatively short lead time to switch on production in the US and switch off production. About a 9-month turnaround, roughly. Another thing to think about is costs in other areas, okay? Here we have new field development costs for international oil companies, for the IOCs, okay? And you can see all the various areas where they, in terms of the ranges. And here we haven't included every single field. These are sort of more where the fields are concentrated, okay, in these bars. So these are the key concentration areas. And you can see here, off on the right, these are the areas that OPEC and especially the Saudis are targeting in terms of these are the more marginal, high-cost areas that the Saudis essentially want to say, hey, slow down your production growth in these areas. And you can see U.S. tight oil, North Sea Arctic, Canadian oil sands, biofuels, these are all the marginal sort of high-cost production that are under target, that are under threat by the Saudis, the recent Saudi move. Now, I promised you a little bit of detail. This one, again, put your thinking cap on here for a second, because this is really key. This is key in understanding the balance and how prices will move over the next several years. Okay? Now, what we do here is we compare, first of all, the easy part is demand. Okay, this is what we expect in terms of demand growth globally through 2020. In 2014, we saw growth of about 700,000 or 800,000 barrels a day. This is very low historically. Okay, typically we had gotten used to well over 1 million barrels a day growth. This is what happens when prices are high. Okay, 2015 we expect a bit of a recovery, and 16 and 17 we do expect a price-related demand recovery. Prices have dropped, we will get some recovery in demand. Okay, so that's the demand picture. Oh, sorry, I keep hitting the wrong button. This is the supply picture. And here we're focusing on non-OPEC supply. Okay, so non-OPEC supply. And you can see non-OPEC supply grew by much, in 2014, grew by well over 2 million barrels a day, over double the amount of demand growth that we saw. Okay? So what did OPEC have to do in that environment? If OPEC wanted to support price, if demand was only growing this much, and non-OPEC supply was growing this much, they would have had to cut their production substantially to balance the market, right? So we can see right here, since the Saudis chose not to cut, we can see what happened. We can see why prices dropped so much. Okay, we had way, way too much production, and OPEC didn't react. In 2015, we actually see that non-OPEC supply will still grow more than demand, more than global demand. It's not till 2016 that we start to see a gap. Okay, and OPEC can fill this gap in here. Okay, so two things can happen. Either OPEC can fill the gap or prices can start to recover. Okay, so a gap gets created for OPEC. The question in here, though, is who's going to fill the gap? Okay, now the Iraqis have designs on filling this gap. Okay, the Saudis, of course, would like to have everyone, have the market, have a gap get created, prices start to recover. But when we look around at other key members of OPEC, Iraq wants to continue to increase production. Iran potentially wants to come back for sanctions and increase production. So that gap quite quickly can get filled. And this is a key issue. Okay, if you look at if you look at Iraq and their production profile going forward, it's quite aggressive, moving from somewhere around 3.5 million barrels a day up to over 6 million barrels a day going forward. And this is looking at Iraq conservatively. Okay, Iraq has great potential in terms of production. Of course, there's big questions with ISIS, and we'll discuss some of those later, I think, during the Q&A period, in terms of some of the uncertainties related to Iraq, but certainly it has huge potential. I'm going to skip one or two of these. A question that often gets asked is, okay, we know prices have dropped. Okay, we know that it'll impact supply to some extent. What about demand? should we see a big demand recovery? Okay, should we see a big demand recovery? Well, we'll see some demand recovery, and we've already started to see it. But a key problem right now is that in a lot of cases, the prices are not getting passed on to the end consumer. The price reduction is not getting passed on to the end consumer. If you see here, this is over the period June to February, we saw that Brent crude dropped 50%. It dropped 50% in terms of price. But when you look at the retail price in various countries, it hasn't dropped near as much. And actually, in some cases, it's even gone up in terms of retail price in local currency. Okay, so what's been happening? Well, in several countries, if you look at Indonesia, you look at China, you look at Malaysia, a lot of these big consumers that had led growth, they've said, okay, oil prices have come down, let's cut our subsidies, let's move to market pricing, or in the case of China, let's increase taxes on oil. Let's increase taxes to dampen that impact. So of course, if the consumer doesn't feel it, right, if the price decrease isn't passed on to them very much, then they won't react, or they won't react as much as we might expect. Another key factor is this strength in the dollar. Okay, if you look at some of these countries like Russia, for example, their prices in dollar terms, I mean in local currency, have actually gone up, right? Because the US dollar has been so strong. So the key consumers, if we look around, there's basically 5 big consumers of oil globally. The non-OECD countries have been driving global demand growth. Okay? OECD has been in decline. The non-OECD has been the engine of growth. And that engine of growth is slowing down a little bit. It's not dead, but it's slowing down a little bit. We discussed a little bit earlier about China and some of the issues. You know, I think there's a lot of close China watchers in this room, and we know that their economy's been changing structurally and slowing down, and that certainly had a large impact on key fuels like diesel in terms of diesel demand. So China's been slowing down. India's doing okay, but it's from a relatively low base. It's not a huge consumer. And then also the Middle East is, of course, going to get impacted by the fact that oil prices have dropped. So when you look around at all these key consumers, there's definitely slowing down. Okay, there's definitely a slowing. So when we put all this together, what we have is we have a new price where we're essentially hanging our hat. This is the futures curve. Okay, this is the future curve for Brent and WTI. Now, futures curves do not project the future in any way at all. Okay, they don't project the future, but they do give us an indication of market perception. And if you ask to me, okay, could oil price go over $100, go to $110, $120 again on a sustained basis? Well, I would say we would need a change in our perception about the forward market. We would need to decide again that we're going to move into a period of extremely tight oil. We're going to move into a period where we're going to worry again about peak oil, these type of issues. The forward curve right now is settled around this $70 a barrel type level. Okay, so it certainly has changed. The perception has shifted dramatically. So this is our price forecast. And I'm bumping up against the limits of my time here, so I'm going to talk a little bit about price forecast and then move to gas for just 1 or 2 minutes, okay, to talk about LNG. What do we see in terms of price? This year, we think, as I mentioned earlier, we think we're going to get one more dip in the oil price, okay, over the next several months. So the test is on me very quickly here. As we move out to the end of the year, we think we'll recover to about $60 a barrel Brent. Here we're focusing on Brent. And then as we move through 2020, we're going to have a tension. Okay, there's 2 key tensions driving the oil market. One is obviously OPEC would like to have a higher oil price. The Saudis and certainly certain members of OPEC would like to have a higher oil price. So they will be tempted, once they see the impact on the US and other areas where production growth starts to slow, they will be tempted to get together and say, let's cut production a little bit and increase the price. But then what happens when you increase the price? US production starts to come back, okay? And then all these challenges that we have start all over again. So essentially what we see between now and 2020 is that we're going to be on a roller coaster, essentially, in terms of price, where you're going to get OPEC reactions, OPEC conflicts. You're going to get the U.S. swinging around and key producers coming in and out of the market, especially in the U.S. So we're going to be back to a more normal world for the oil market. Okay, 2010 to 2013 was a strange world for the oil market. We saw no volatility. We're going to get back in a world where we do see volatility. And then once we get out to 2020, we see core pressures start to emerge again in the oil market. And those core pressures are driven the fact that we're seeing CapEx cuts right now. We're seeing reductions in investment, which are going to impact the market 5 or 6 years from now, looking ahead. So then we start to see some upward pressures on the oil price again. Last point I'd like to make here is on LNG. Okay, let's shift over to LNG. Korea is obviously, KOGAS is the single largest LNG buyer in the world. Okay, obviously, LNG is king in terms of gas in Korea. And actually, LNG is king. Asia is the king of LNG. When you look at the LNG market, Asia is where the heart of it is. Asia pays the most money, so everyone wants to go to Asia. Okay? So the total global LNG market right now, in terms of the capacity, is a little bit less than 300 million tons. Okay, so 300 million tons. Have that in your mind. And then you look around what has been proposed for LNG. And we look at various areas. The US, over 300 million tons. Canada, over 300 million tons. If we add it all up, there's about 800 million tons of proposed LNG capacity out there globally. Way too much. It's not all going to happen, right? So when everyone says, oh, we're going to build an LNG project, it looks great. Clearly, we knew even before the oil price dropped that that couldn't happen. And now we're even in more dangerous territory. We're in more difficulty for LNG projects. Why? Well, if you look, let's start with Canada, for example. If you look at an LNG contract price right now, a long-term LNG contract price, at today's oil prices, you would be paying about $8 or $9 per million BTU for that gas. Okay, if you signed a contract today at recent type contract terms linked to oil. Canada, those projects in Canada, including one that KOGAS is involved in, are really only viable at about $11 or $12 per million BTU. So the price right now is about $8 or $9 per million BTU. Your costs are about 11 or 12. Do you think those projects will go forward? It looks tough. Okay, it looks tough. It looks tough for Canada. It looks tough for East Africa. And the US, frankly, it even looks tough. Because for the US, you have to add about $7 per million BTU to get the gas from the US to Asia. So currently, gas prices are about $3 in the US. Add $7, it's still $10 per million BTU. Okay? It would not be competitive with long-term oil linked in the US. So every single LNG project now looks very challenged. Okay? So the key, when you think in terms of investment going forward though, is when we look at oil and we look at gas, and I'll close on this, when we look at both sides, what has to happen is costs have to come down. And right now we're in the midst of this. We're seeing all of our clients pressing their suppliers to reduce costs. We're seeing anecdotal evidence of a lot of cost reductions. So the key, when you look at companies that will do better, are companies that can force costs down further and have a large part of their portfolio in areas where costs can get reduced. And I think we think here, internally, we think about areas where you'd have a lot of more upstream rather than downstream. Like I'll give you an example. Okay, look at Mozambique, for example. In East Africa, Mozambique is one of the key areas. A large part of their costs are in the upstream. And that's the area where we're seeing the largest cost reductions. So if I had to look at this whole list and say who may be cost competitive or the most cost competitive 3 or 4 years from now, Mozambique looks pretty good. It looks challenging for everyone. Everyone's going to get challenged by low prices, but some areas look more challenged than others. And with that, I apologize, I've run a little bit over my time, so I'll turn the mic back over. Thank you again very much.